How do states define agricultural use for property tax exemptions? Imagine owning land that you want to keep in farming or related activities, but you're not sure if it qualifies for lower property taxes. Every state has its own rules about what counts as agricultural use for tax breaks. These rules help decide if your land can get that special exemption. States usually look at what kind of farming or agricultural work is happening on your land. This can include growing crops, raising animals, or even horticulture like planting flowers or trees. Some states also recognize specialty uses like mushroom farming or using land for solar panels that support farming. Next, states often set a minimum size for land to qualify. For example, many states requiring at least 5 or 7 acres of land. But if you have less land, you might still qualify if your farm makes a certain amount of money each year. This sales threshold can be $10,000 or $50,000, depending on where you live. Income or sales from agricultural products are also important. The land must produce enough to show it is used for business, not just for fun or recreation. The sales need to come from actual farming or related activities, not just storing equipment or supplies. Some states requiring that the land has been used for farming for a certain number of years before you can get the exemption. Usually, this is around 2 years, but some places may have exceptions for new farmers. Buildings and equipment used only for farming can also be part of the definition. For example, barns, greenhouses, or silos used solely for farming activities may qualify for exemptions too. If these structures are used partly for other purposes, they might only get partial exemptions. Certain states have programs like the Williamson Act in California. Landowners agree to keep their land for farming for a set period, like 10 years, in exchange for lower property taxes based on income rather than market value. Urban farms can also qualify for exemptions in some states. These rules often specify parcel sizes, like from 0.1 acres up to 3 acres, and whether the farm is for personal or commercial use. Restrictions on buildings or non-farming structures may also apply. To qualify, landowners need to show they are actively farming or producing agricultural goods. Keeping detailed records of sales and land use is essential. You might need to apply every year or follow specific local procedures. If you lease your land to a farmer, you can still qualify if the land is actively used for farming. Participating in local programs or contracts that restrict land use to farming can help secure long-term tax benefits. These programs often requiring commitments but can provide steady relief. In the end, clear definitions of agricultural use help ensure farmland gets the right tax treatment. This keeps farmland affordable and supports farming operations by reducing taxes based on income, not full market value. It encourages landowners to keep their land in farming and helps preserve agricultural land for future generations.